Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 18th, 2018, and in today's video I wanted to talk about setting realistic investment expectations. And the subscript is, they aren't what you think they are. Since I've been doing the podcast, or not podcast, but making these videos and writing blog posts on my blog, Actionable Intelligence, I get a lot of feedback from people that send me emails or talk to me. And I get the impression from a lot of people that they are novice investors, or they're just beginning, or they don't have a lot of experience with investing. And the reason I say that is because I think some people's expectations for investment returns are skewed too high. And I think that's very dangerous. Because when you think that you're going to find a lot of stocks or investments that are just going to double and triple or go up and be 10 baggers in a year or two, you are setting yourself up for disappointment. Also, when you are setting your expectations that way, you are not going to be successful long term. You are not going to get those results. You are going to become disenchanted. You are going to forego the wealth building potential that exists if you actually know what you're doing and you use time and compounding and to your advantage. So what I wanted to do today was just talk a little bit about what's realistic in the markets. Also, I wanted to showcase another white paper that was written by a guy that I'm a big fan of, Med Faber. He wrote a paper recently, earlier in the summer, called The Investment Pyramid, or the New Investment Pyramid. It's kind of a riff or a takeoff on the food pyramid, if you remember the USDA food pyramid. I will put a link to that in the show notes, but I definitely recommend that you take a look at it, because I'm just going to highlight one part of the paper, but the entire paper is very, very good and applies. All investors should read it and consider implementing some of the views that are written in it. But anyways, so here's a chart that I cribbed from Raymond James. It basically shows compound average returns over time for different types of stocks and bond classes. So if you see here, it's if you look at the middle where it's talking about compounded annual return, you see that since 1926 up to 2006, small stocks average 12.1% a year, large stocks 9.9%, government bonds 5.5%, treasury bills 3.6%. So you can also see the various ups and downs in the market, and but you can see that if you would have invested, $10,000 back in 1926 in small stocks, you would have only averaged 12.1% a year. And you can see there were many times when you were having negative returns, and then there were times where you're having massive returns. That it all ended up where you ended up with a 12.1% return. If you would have put your money in here and not taken it out, reinvested dividends, not touched it, you would have got here. So I think that is very instructive, because what I see happening is people say, I'll talk to people, let's talk about uranium. I've been a little bit maybe hyperbolic about it, but it is possible in these type of investments to make above average returns, okay, for some period of time. And that's what I try to do to get better than average returns, but that's no guarantee. So we'll get into that later, but I just wanted to show you that even if you just bought large cap stocks, your average return, I'm talking blue chip stocks like in the Dow and S&P, you would have only averaged 9% a year. 9% a year. Now the other thing that's on this chart that you really should be cognizant of, that you have to incorporate into your thinking, is inflation. This is the gray area. And the inflation has averaged 3% a year compounded. So you can think of as inflation as eating away at your purchasing power and your wealth like termites in a house. So if you had a 12% return in small cap stocks averaged over the year, you have to subtract 3%. You would have had a 9% actual return. So nobody really talks a lot about inflation, this insidious growth of money supply or of currency units that the government constantly creates over time. We've talked about this before, the boiling frog scenario, but you need to incorporate that into your thinking. But overall, the point I'm trying to make here is the average return of just buy and hold for long term is not very high. Well, it's high, I mean, relative to treasury bills. It's not, risk-free assets like treasury bills, but it's not 20 or 30% a year. So this kind of segues into the next slide, which is investor performance over time. And you can see the dark blue being the S&P returns for the different time frames. And the average individual investor is in aqua blue here. And you can see that under every single time frame, whether it was 12 months, 5 years, 20 or 30 years, average investor underperforms the market. So I've said this before, for the average person that is not interested in researching, doing work, I wouldn't recommend someone that doesn't know how to build a house go out and build their dream home. They don't know how to do it. It probably won't turn out well. If you are investing for the long term and you have no interest in it or no knowledge, I don't recommend that you do what I do and what professional investors do. You're not qualified and you will have subpar results. What you should do is you should, based on your risk tolerance and based on your age and your goals, you should buy and hold for the long term. If I was 20 years old and I was just trying to have a career, or I was doing something and I wasn't interested in investing, I didn't want to do the research, I didn't want to do the work because it's a lot of work, I would just find a low cost, no fee S&P fund like Vanguard offers, and I would just put $200 a month in it until the day I retired. No matter if the market was down, whether it was up, if it went down 50% in a year, whatever, that's what I would do. That's what most people should do. But they're not going to do that because they're do-it-yourselfers. They know how to do this. It's not hard. Anybody can do it, right? So they're going to go out and this is the returns they're going to get. They're going to have subpar returns and subpar results, and their goals are not going to be met. You have to understand something about investing. Okay, it's a profession, it's a skill, it's a craft. It takes time and effort. It takes knowledge. It takes a long time to understand what's going on and to benefit from that knowledge. You can't just do it as a part-time thing like on weekends. You're going to get creamed. These are the facts. Now, there's a lot of people out there listening to this podcast or this video that are going to say, well, I'm not that guy. But sincerely, look at your returns. Are you that guy? Because I suggest that most people are that guy. So to hammer the point home even further for the people out there that really think that they're going to beat the averages, I will show you. It's hard to see this chart, but I will put a link to it. This is out of the most recent Berkshire Hathaway annual report, and it basically shows every year that Berkshire Hathaway's been around. It shows the increase in book value and the average return. And then in the third column is the average return for the S&P 500 with dividends reinvested. So basically, for the period of time that this shows, and I'll put a link to this so you can see it easier, the S&P returned 9.9%. Berkshire Hathaway, run by Warren Buffett, a professional investor, arguably the best investor in the history of the world, his average return during his investing career with Berkshire Hathaway is 20.9%. That means through all the up and down years, the average was 20.9%. That's basically doubled what the S&P did. So the world's best investor, who his entire life has been devoted to this, who spends 12 hours a day reading analyzing, thinking, average 20.9% per year. And yet people call me up and go, think their expectations are going to be this. As a part-time investor or somebody with no knowledge and no education and no effort, it's not going to happen. I'll say that again. It's not going to happen. Here's another guy that's a guy that I like to follow. His name's Prem Watsa. I've talked about him before. He runs Fairfax Financial. It's a Canadian conglomerate similar to Berkshire Hathaway. Prem Watsa is known as goes by the nickname of the Warren Buffett of Canada. He didn't dub that himself. Other people have applied that to him, but he basically has modeled Fairfax Financial. Basically set it up the same way as Berkshire Hathaway. He has a lot of insurance holdings, takes the excess float from the insurance premiums invested in the various businesses, and then it's free source of capital. That's how Berkshire operates with Geico and various insurance holdings. So he doesn't show the S&P here, but he does show the intrinsic value or book value, the worth of the company if you were to sell off all the assets. He's increased that since 1986 till last year at a compounded annual growth rate of 19.5%. And the stock price of Fairfax Financial has increased on an average of 18% per year. Now, Prem Watsa, I've looked him up. He's worth about $1.5 billion. He came to Canada with nothing as a student from India, started from scratch this firm, this investment set up in 1986. Now he's worth $1 billion. So again, look at the numbers, 18% compounded. That's it. Not 30% a year, not 100% a year. Now there were some years in there where they had some big gains. I mean, when they were smaller, that 292% increase in the stock price in 1986, that 145% increase in 92. And these are the things that can happen, guys. When you are investing long term and you invest in various things like we're talking about uranium or something like that, and it's possible to get 100, 200, 300% return. But then there's going to be some years, or there's going to be some things that you buy that are going to go down 30 or 40%. You're going to have to sell them because it's not working out. So I'm not saying it's not possible to have superb results. There is. I've had several, I've had many doubles in my career. I've had many 200, 300, 400% increase stocks that went up that much, but I didn't have all my money in them. I didn't just swing for the fences on every investment. They represented, 3% of my portfolio, and they juiced my portfolio. But, using prudence and not trying to lose money, I mean, there's no guarantees. So, yes, you can get various asset classes to outperform, but you have to use a prudent style and asset allocation and risk control that's going to keep you from, putting all of your money into uranium. I certainly wouldn't suggest that. Now, there's going to be some guys that put all their money into uranium, and they're going to get the right stock, and they're going to, after this whole thing's over with, they're going to come out and say, this guy turned 10,000 into, 20 million. But that's not going to be the average person. And more than likely, that person's going to blow up. It's like a lottery winner. I mean, it's like you went out there and you got the right numbers, and you're not a professional investor. You got lucky. It's, can you do it year after year? Can you grow your wealth year after year prudently, consistently? That's the goal. Not to be, hit a home run. Not to be a two-outcome guy like in baseball, like Dave Kingman or some of these guys, get up there, you either strike out or you hit a home run. Now, this is, I want to take a little look at the Meb Faber paper I was talking about earlier, the investment pyramid. I'll put a link to it in the show notes. One of the things he talks about on the bottom of the pyramid is don't do dumb things, aka blow up your own portfolio. And, left to our own devices, we will tend to do dumb things with our money, such as, he gives some examples, doubling down on falling stocks, chasing hot stocks, getting caught up in a herd mentality when fundamentals scream otherwise. So we've seen this before. We've talked about this before. This is just an example of some things you can't do. You cannot lose money. I mean, what did Warren Buffett say? Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. I mean, Sometimes it's not kind of boring. People don't like hearing these cliches, but they're not cliches. This is the keys to success. This is how you are successful doing this. So what I liked about this paper was he kind of goes into how, okay, we've determined that we don't do dumb things, but what do we do to avoid it? And I think he gives two, in the paper he talks about two words here, awareness and humility. And I'm quoting him directly here. It says, awareness is the simple recognition that you're inclined to hurt your portfolio. And that's true. I mean, I will talk to people all the time, and we get on the subject of investing, and they'll be like, yeah, I'm invested in this. I'll be thinking to myself, what is the person's reasoning on that, you know? Or when we were in the Bitcoin stupidity last year, and I was on the job site, and I talked about this in another video, where all these young guys were there, all telling, you know, all they wanted to talk about was Bitcoin. I'd go into a meeting to talk about the construction that we were working on, the project, and I had to literally shut these guys up. You know, I'm not here to talk about Ripple or Dash or whatever you guys are talking about. You guys, that's the herd mentality. You know, I've seen it over and over and over. And guys, I'm not saying this like I'm some perfect guy, because I'm not Prem Watson and I'm not Warren Buffett. I had to learn all of these things myself too, and it took me many decades, not a couple months, not a couple years, many decades. I lost a lot of time learning these things the hard way. There is no quick way to get wealthy. Yes, lightning strikes some guy that creates an app or some software program, but that's not most of us. Most of us need to invest money long-term for different goals, putting kids through college, retirement, taking care of a spouse or parents that are old or sick. We're not here trying to, you know, become overnight wealthy. It's not possible. And that's the awareness you have to have. And the fact that if you're going to have these wild goals, like get rich quick, you are going to blow yourself up, because you're going to be chasing all kinds of schemes, scams, and it's just not going to work. You have to look in the mirror and you have to say, people that have become successful investors, what have they done? We've talked about that in other videos. What is the common denominator? It's consistent returns over a long period of time and letting it compound. That's it. And risk control. That's it. So awareness, again, the simple recognition that you're inclined to hurt your portfolio, and humility, here's the big one, is what enables you to accept that reality and seek a better way. So I've cribbed this out of the paper, the New Investor Pyramid. I think it's kind of cool. Like I said, I'm going to put a link. I suggest you read this white paper. It's short and excellent in my view. So we've talked about what not to do. So what do I do? What have I come up with after all of the decades of monkeying around, wasting time? What am I doing for consistent success? And it has been working for me for the last, you know, many years, several years. And I've taken this right out of the, you know, 101 in the stock market book, and and Meb Faber, and some of the things that he's written, and going back to classic Ben Graham value investing. Okay, 3 methods to give myself above average chances at beating the market. Buying $1 of assets for 50 cents. So that's what I look for. I'm looking for a basket, a company, something selling for 50 cents that's worth $1. And that requires work and research. And even when you find something, you have to then really deep dive it, analyze it, understand how to read a balance sheet, understand how to read an income statement, understand a business, how business works. And these are not skills everybody has. Another way that I use is buying out of favor industries that are at an inflection point. I mean, this is typical commodity cyclical investing. Buying at the bottom, selling at the top. Again, it takes a certain amount of awareness and understanding of where you're at in a commodity cycle. That takes research. Okay, that's where we are in uranium. We're buying out of favor cyclical industry that is at an inflection point. Same thing with oil. It seems simple to say, but hard to do. Another way this thing's been a cash cow for me, buying countries that are going from terrible to less terrible using the CAPE ratio. Now, this is a super long-term methodology. This is not something that typically works in a year or two. Sometimes it does, sometimes it doesn't. It's not a market timing tool. What it tells you is this particular country is selling for a price to earnings ratio that is showing you that it's lower than its mean, or if it's selling above the mean, because I'm a big fan and understand and advocate for mean reversion. You're going to see that in the United States. We are selling, that's a perfect example, we are selling at a all-time high valuation, and yet the stock market continues to be maintained at a high level, even though it's overvalued on just about every metric out there. However, I can guarantee you that over the next 10 years, the returns in the U.S. stock market will be subpar relative to various undervalued countries you could be buying. And we talk about that in my newsletter, and I've talked about that on articles on my website. Now, the next one's just the Warren Buffett methodology that he learned when he kind of transitioned from being a Graham devotee, when Charlie Munger became his partner, and Charlie kind of introduced him into this methodology, which was buying great businesses at a fair or bargain price and let the management compound earnings and reinvest those earnings back in the company. Simple matter of buying businesses with moats that have above average return on equity, return on capital invested, and just let those managements compound. What are the examples? Coca-Cola, Gillette, McDonald's. I mean, I'm not saying those are the companies you should be buying now, but those are examples of that type of methodology. And the one thing I want to point out is, for all of these methods to work, one thing is required: patience. You know, when you buy a dollar of assets for 50 cents, it's not like, you know, you're some genius and everybody's going to say, wow, you're a genius, John, you found the stock. No, it may never be recognized, or you may have to wait till some guy like Carl Icahn comes along, or some, you know, until it gets traction. And sometimes these things take time. It's the same thing with buying an out-of-favor industry that's at an inflection point. Just because we think uranium's going to go up doesn't mean it's going to go up when we want it to go up. I mean, we can understand all the fundamentals, but it's just a matter of waiting. And I'm just sorry to say, a lot of people can't do these things. I mean, I'm really seeing that why most investors are not successful is because they have no self-awareness, they have no humility, and they have no patience. And so they're just jumping around like a frog on a lily pad looking for the next hot thing, chasing performance and making bad decisions. And you see the results. It's not me saying it. I was the same way. I'm just going to be honest with you. I'm out there, and you can't afford to have 20 or 25, 30 years get wasted when you have capital to invest and you're not doing things correctly. You're giving up a lot of money because you are not doing things correctly. You're not getting that compounding. So I hope you got something out of this video. I don't say this stuff to be mean to people or to denigrate. Like I said, I'm self-introspective. I made a lot of these mistakes. I had to learn the hard way. I didn't have anybody to teach me these things. As I got older, I finally decided that I was sick of subpar returns, and I began studying successful people. I mean, you don't have to reinvent the wheel. No one's that smart. Just study what successful people have done and emulate them. It's not difficult. So that's it for this week, guys. Appreciate the support and appreciate people tuning in. Keep the comments coming, and we'll talk to you next week. Thanks.